Hi, this example shows you how to do the journal entries with treasury stocks. And I will highlight the key point you have to pay attention related to treasury stocks. Treasury stocks purchase, we call it book value approach. What does that mean? It means when we do the journal entries, the transaction base is going to be based on the book value, which is the time when the stocks, the price you pay when you buy back the stocks. Okay, so the company have treasury stocks is they buy back the stocks, but they don't retire the stocks, which means they can reissue the stocks they purchased back. Okay, in that case, we call this type of stocks bought back treasury stocks. Very important, the normal balance for the treasury stocks is debit. All right, so let's take a look at this transaction. And the company have outstanding 40,000 shares of $5 par value common stocks, which were issued at $30 per share. And for our example, on January 1st, the company made the first purchase, buy it back. I'm just gonna write it here, slightly larger. Okay, January 1st, and the company purchased 5,000 treasury stocks at $45 per share. And what should we book the journal entry? We're just going to debit treasury stocks. And credit cash. It's fairly straightforward. That's how much you pay for the treasury stocks, 5,000 shares at $45 per share. So that's the journal entry. The journal entry is debit treasury stocks and credit cash. Okay. So next one is going to be March 2nd. On March 2nd, the company made the first sales, and they sold 500 treasury stocks, this time at $40 per share. And we're going to start with the cash. That's how much you receive from the sales. Okay, $40 and $500. So that's the cash. Dollar amount. So what happened when you sold the treasury stocks? You have to remove 500 shares treasury stocks from your book. And remember here, we're using book value approach. So the valuation base is going to be how much you pay, right? And here, 500 shares, I know you paid $45 per share. That's the amount that has to be removed by credit treasury stock. Here, credit. Okay, so if you look at here, you debit 20,000 and credit 225. You debit 20,000, you credit 22,500. So we need to have something on the debit side. On the debit side, how much we're gonna have is here, because you essentially selling at a loss. You paid 45 and you sold at 40, and we're going to use the return earnings by debit return earnings to reflect the fact you are actually having a loss during this transaction. Okay. So next one, June 3rd. On June 3rd, and you sold again, this time at $50 per share. Again, we first do the journal entry for the cash to reflect how much money you receive from this transaction. You sold 2,000 shares at $50 per share, and that's how much you receive. Okay, and how much we have to remove? Again, book value approach. We're going to take it out. It's right here. Treasury stocks. Treasury stocks. How much you have to remove? 2,000 shares, and you paid 45. So that's the amount you're going to remove. And now you can see here to make sure debit equal to credit, you have something to be on the credit side. Okay. That's right. So how much you're gonna have is this. So now you can see here what happened. You sold at 50, you bought at 45. So essentially you have a gain, right? The gain is $10,000 from this. And when we have a gain from Treasury stock approach, we are going to use this paid in capital. Treasury stock account. Okay. Why we use the paid in capital account? Because this account is our cookie jar. All right, now continue. On August 3rd, the company sold again. Just like what we did before, we're gonna use the cash account to capture how much you receive from this. You sold 2,000 shares, and this time you sold at $30. So for this transaction, you actually received 60,000. And here, again, we're going to remove Treasury stocks based on the price you paid, book value approach. And this time you sold 2,000 shares and you paid 45. And again, we're going to remove 60,000 from our balance sheet. And now you can see here we have a loss again. This loss this time is 30,000, which is a difference between 60,000 and 90,000. And for this 30,000, what we're gonna do is first we're gonna look at our cookie jar, right? Do we have anything in the cookie jar? And the answer is yes, we do have this paid in capital. We put some cookie in, which is the 10,000. So we're gonna take it out from cookie jar first. Okay. So we're gonna debit this, and you know, if you look at this, you'll be like, wait a minute, debit is not equal to credit. What are we gonna do? We need another debit, so we're gonna move it here, okay? Because here the loss is 30,000. We're gonna have 10,000 in our cookie jar paid in capital account, and we're still $20,000 short. So here to figure out where we're gonna get this 20,000. 20,000, 90 minus this, minus that. So where we're gonna get the 20,000? The 20,000 is going to come from the return earnings. Yeah, so that's the journal entry. Let's summarize what we studied so far, okay? Treasury stock is going to use a book value approach, okay? Therefore, at the time when you purchase, you debit the Treasury stock using the price you pay. When you sell Treasury stocks, you're gonna remove the Treasury stocks also based on the price you pay. Okay, so that's the way you're gonna use when you remove from your book. And the difference, if you are making money, have a loss, have a gain, you are going to put in a cookie jar, which we call the paid in capital Treasury stock account. If you have a loss, first look at, do you have a cookie jar or not? If you have a cookie jar, do you have a cookie in it or not? If you don't have any cookie, use return earnings to book the loss. If you have a cookie, then you take out whatever you have in a cookie jar first, then the leftover using return earnings. That's all.